Start with a myth. Is the United States the poorest country in North America? No. The numbers say otherwise. We'll compare GDP, GDP per capita, median income, and poverty, then explain why federal paychecks sometimes pause. First, GDP. The U.S. economy is the region's largest by far. Size isn't everything, but it sets context. America drives a big share of North American output. Next, GDP per capita. On average, Americans produce and earn more per person than Mexicans, and are broadly comparable with Canadians, depending on measure and year. Median household income tells the paycheck story. The U.S. sits high in the region, though costs vary by city and state, so local experience can feel different from national medians. Poverty rates? Definitions differ, but by comparable international measures, the U.S. is not the poorest in North America. Trade-offs remain. Inequality and affordability matter. So why the confusion? Viral clips cherry-pick prices or local hardship. A clear read compares like with like, GDP, per capita output, income medians, and poverty measured the same way. Second question. Why do federal paychecks sometimes pause? Start at the Treasury. Cash management follows law, not headlines. Congress must pass appropriations, and the president sign them. If they lapse, agencies lack authority to obligate funds. The Anti-Deficiency Act bars spending without appropriation, with narrow exceptions. During a shutdown, accepted employees work without pay until funding resumes. Others are furloughed. Pay pauses reflect legal authority, not national poverty. Don't mix issues. A funding lapse differs from the debt ceiling. Shutdowns pause some operations. Debt limit standoffs risk Treasury's ability to pay bills on time. Resolution comes via a continuing resolution or full appropriations. Once enacted, back pay is released and delayed paychecks catch up. Bottom line, the U.S. is not the poorest country in North America, and paycheck pauses stem from appropriations law. Next, we'll track the data with transparent dashboards and clear methods. North America's income landscape. United States, Canada, Mexico, and the Caribbean. We'll compare GDP per capita, median household income, and poverty, clear, sourced, and comparable. On nominal GDP per capita, the US and Canada sit high. Mexico is mid-tier. The Caribbean spans wide. Bahamas and Barbados higher, others lower. Adjust for prices. PPP narrows gaps. Mexico rises relative to nominal, some Caribbean islands shift, while the US and Canada remain leaders. Median household income. US typically tops Canada on levels. Both far exceed Mexico. Use median, not mean, to capture the typical family. Poverty depends on the line used. National thresholds versus World Bank lines. Canada and the US are low by national lines, higher on relative measures. Haiti is the region's poorest, low GDP per capita, high poverty, while neighbors like the Dominican Republic trend higher. Bahamas and Barbados sit near the top. Mexico's incomes trail US and Canada, but have risen with industrialization and remittances. Poverty has fallen over decades despite shocks. Inequality shapes the picture. US Gini above Canada. Mexico and several Caribbean economies show higher dispersion. Means can mislead. Within-country gaps matter. U.S. states, Canadian provinces, and Mexican states show wide spreads. Urban hubs skew national averages. Remittances lift households, especially in Mexico and the Caribbean, cushioning shocks and raising consumption, even when local wages lag. Shocks reshape rankings. Hurricanes, commodity swings, and pandemics hit Caribbean incomes hardest. Diversification and insurance improve resilience. Methods check: nominal versus PPP, household size, taxes and transfers, and informal income. Document assumptions before comparing. Sources: IMF for GDP levels and PPP, World Bank for poverty and remittances, OECD and national stats for median incomes and distribution. Quick read: GDP per capita bars, US and Canada high, Bahamas and Barbados elevated, Mexico mid, Haiti lowest in the region. Median income snapshot: US near the top, Canada close behind. For Mexico and many islands, rely on consumption or disposable income proxies. Bottom line, the US ranks near the top. Canada close. Mexico mid-tier. Haiti is poorest. Compare with PPP, medians, and clear sources, then decide. The long road begins with the balance sheet. The US is a $27 trillion plus economy that issues the world's benchmark safe asset, Treasuries. To read power, start with revenues, outlays, the deficit, and the stock of debt. Revenues first, mainly individual income and payroll taxes, then corporate and excise. Think broad base, cyclically sensitive, paid monthly and quarterly with withholding smoothing the flow. Outlays next, social security and health programs, defense, interest, and other discretionary spending. Mandatory grows with demographics, interest grows with rates and debt stock. The deficit is the gap, outlays minus revenues, larger in recessions, smaller in expansions. Structural choices set the baseline. The cycle pushes it up or down. Debt is the cumulative stock. Distinguish debt held by the public from intragovernmental holdings. Flow is deficit, stock is debt, different dials, related signals. Treasuries are the safe asset. Bills, notes, and bonds across the curve, used as collateral worldwide. Prices and yields transmit risk sentiment and funding costs. Issuance is routine. Treasury auctions, primary dealers, and a published calendar. Metrics: bid to cover, indirect bids, and tail versus when issued levels. Interest costs depend on rates and maturity. Extending average maturity reduces rollover risk. Higher policy rates raise near-term interest outlays as older debt refinances. Solvency versus shutdown. Funding lapses or debt limit standoffs are political and operational, not a sign the US ran out of dollars. Default risk is distinct, and markets would price it fast. Markets watch the tape. Treasury yields, curve shape, auction demand, and CDS spreads. In risk-off episodes, safe haven demand for treasuries often rises. Key ratios: debt to GDP, interest to revenue, foreign share of holdings, and inflation trend. Track levels and momentum, not headlines. Policy frames the path. Automatic stabilizers widen deficits in downturns, narrow them in recoveries. Long-term choices on taxes, benefits, and investment set the trend. Checklist: revenues, outlays, deficit, debt, interest, auctions, market signals, rate depth, resilience, and credibility over time. Sources to watch: the monthly Treasury statement, auction announcements, yield curve moves, and interest costs as a share of GDP. Update cadence matters. Bottom line, the US finances a large, innovative economy with assets the world treats as safe. Credible execution, not rhetoric, keeps that status. Stand by. Why can federal pay pause? It's a legal and process issue. When Congress misses appropriations, agencies can't spend without authorization. OMB issues shutdown guidance, operations narrow, and pay is delayed until funding resumes. Not because the nation is poor. It starts with appropriations. If Congress doesn't pass full-year bills or a continuing resolution by the deadline, the clock runs out, and agencies face a lapse in funding. The Anti-Deficiency Act bars federal obligations and payments without appropriations. Only limited, accepted activities can continue to protect life and property or meet constitutional duties. OMB issues shutdown guidance. Agencies activate contingency plans. Who stops? Who continues, and what obligations pause until appropriations resume. Agencies classify staff. Accepted continue mission-critical work. Non-accepted are furloughed. Both groups may see delayed pay. Status depends on the role, not the person. Pay timing. Even accepted employees can work temporarily without immediate pay. Payroll posts later, in full, after a new funding law is signed. What's impacted? Travel and training pause. New obligations stop. Some contracts receive stop work orders. Fee-funded or multi-year programs may continue if they have available balances. What continues? Accepted services that protect life and property. Air traffic control, certain law enforcement, military operations, and critical care functions, under strict legal criteria. Back pay. Historically, Congress grants retroactive pay to federal employees after funding returns. Contractors' back pay is not guaranteed and depends on contract terms and appropriations. Communication. Agencies post shutdown status pages, HR hotlines open, and furlough notices clarify timekeeping and benefits. Follow official updates, not rumors. Not everything stops. Programs with no year or multi-year funds, some trust-funded or fee-funded services, and courts using carryover may operate, subject to available balances. Myths versus facts. A shutdown is not national insolvency. It is an appropriations lapse under law. It differs from the debt ceiling, and short shutdowns typically don't move credit markets by themselves. What to do? Check OMB and agency contingency plans, confirm payroll calendars, track benefits guidance, coordinate with unions, and plan cash flow until retroactive pay arrives. Bottom line, pay pauses are the result of legal guardrails, appropriations, OMB guidance, and agency plans, not national poverty. Clarity, transparency, and planning keep the system credible. Radical transparency starts with the debt ceiling, a statutory cap Congress sets on total federal borrowing. It's separate from the budget. It doesn't authorize new spending. It limits Treasury's ability to finance obligations already passed into law. Think of two tracks. The budget sets taxes and spending. The ceiling limits how much we can borrow to cover those approved bills. When the cap nears, Treasury manages cash against a timeline. When the ceiling binds, Treasury uses extraordinary measures, temporary accounting steps like suspending certain fund investments, to free room under the cap while Congress negotiates. How long they last depends on receipts and outlays. The X date is an estimate, not a guess. Track it with daily statements, cash balances, and announced measures, not rumors. If the cap isn't raised in time, risks escalate. Delayed payments, market volatility, and potential credit downgrades. Alerts should explain what changed and the statutory cause. Historically, Congress has resolved standoffs, raising or suspending the ceiling dozens of times. A clear timeline helps the public see past episodes and outcomes. Crucial distinction: the United States isn't too poor to pay. The issue is legal authority to borrow, not capacity to service debt. Our dashboard cites statute, OMB, CBO, and Treasury sources. Transparency means citing chapter and verse, statutes, dates, balances, so anyone can reproduce the numbers and the timeline. Citizens and researchers can track debt subject to limit, TGA cash, receipts, and outlays. Download CSV or JSON and replicate charts from Treasury and CBO in shared notebooks. Public explainers should mirror the dashboard. A plain language guide to the ceiling, extraordinary measures, and X-date estimates, plus the exact sources used. Journalists and academics get version methods and archives to compare scenarios, cash flow calendars, rollover schedules, and rating criteria, apples to apples. On your phone or a neighborhood screen, compare revenues, outlays, TGA balance, debt subject to limit, and listed extraordinary measures, then tap through to Treasury statements. A live timeline highlights key milestones, ceiling reached, measures invoked, receipt spikes, X-date range, updated as data refreshes. Source links for verification, Treasury daily statement and debt reports, OMB, CBO, GAO, rating agency criteria, and market data for yields and spreads. From fear to informed debate, understanding the ceiling, the timeline, and the data turns heat into analysis and better decisions. Communities get stronger when the facts are visible, and every claim links back to public numbers and the law. Make transparency the default. Publish cash flow calendars, note which measures are active, flag 3 sigma deviations, and disclose methods so anyone can rerun the results. The journey begins with shared facts and calm guidance, while protecting analysts and data users who hold power to account. Start with the Treasury General Account, the federal checkbook. Cash flows in daily from withholding, quarterly taxes, customs, and Fed remittances. It flows out to pay benefits, payroll, vendors, and interest. Leadership under stress starts with clean cash visibility. Inflows: payroll withholding, corporate estimates, tariffs, fees, and asset sales. Outflows: Social Security and Medicare, salaries, grants, vendor invoices, and coupon and principal payments, each on a fixed calendar. Payments ride rails: ACH for payroll and vendors, Fedwire for same-day and securities, card networks for small buys. Settlement windows and cutoffs shape when money hits accounts. Payroll cycles are bi-weekly for many agencies. Time cards approved, files certified, ACH batches queued, funds reserved, and pay credited on payday, mapped to a Treasury calendar. Vendors follow the Prompt Payment Act, invoice, acceptance, net 30, with electronic invoicing, matching to purchase orders, and disbursement via ACH tracked in the portal. During a shutdown, delayed paychecks come from lapsed appropriations, not a lack of national wealth. Without budget authority, many obligations pause. Accepted services continue and are paid when funds resume. Prioritization debates surface in debt standoffs. The Anti-Deficiency Act and existing systems limit line-item triage. Paying interest first while delaying other bills is legally and operationally constrained. Transparency helps. Public dashboards for cash balance, upcoming maturities, payment calendars, and settlement stats, with plain language alerts when appropriations lapse or limits approach. Protect the messengers, whistleblower hotlines, anti-retaliation rules, inspector general oversight, and audit trails for payroll and vendor payments, so errors and manipulation are surfaced early. Resilience tactics, payroll continuity plans, emergency appropriations, bridge clauses for critical vendors, and state-local coordination, keeping payments predictable when shocks hit. Bottom line, steady cash ops, lawful authority, clear calendars, and protected whistleblowers keep government pay and vendors whole. Delays reflect policy and process, not a missing bank balance. A shutdown is a legal lapse in appropriations under the Anti-Deficiency Act. Agencies sort staff into two groups: furloughed, told not to work, and accepted, who must work to protect life and property or fulfill constitutional duties. Pay lags. Accepted employees work without immediate pay. Furloughed employees do not work. By law, most federal employees receive back pay after funding resumes. Contractors and support staff often do not, unless contracts are adjusted. What you'll see on the ground: office closures, reduced call centers, slow mail rooms, paused hiring and training, and fewer public-facing hours at some federal workplaces. Services affected vary. National parks may close or limit access. Passport and visa processing can slow. Small business and housing loans pause. Some food safety and workplace inspections scale back. Air traffic control and TSA remain accepted. History for context: 1995 and 96 lasted 21 days. 2013 ran 16 days. 2018-19 reached 35 days, the longest. Durations matter for household budgets, contractor cash flow, and service backlogs. Back pay is guaranteed for federal employees by statute. Benefits like health coverage typically continue, but many contractors, custodial, food service, security, may not be repaid for lost hours unless their contracts are modified. Practical steps: follow agency contingency plans, set out-of-office notices, secure equipment, record time correctly, check OPM guidance for status, and where allowed, apply for state unemployment. Repay if back pay arrives. Contracts and grants, new awards often pause. Work continues only if funds were already obligated. Contractors should keep written stop work orders, document deliverables, and invoice promptly for work performed. Travel and safety. TSA officers and air traffic controllers are accepted. Airports stay open, though delays can rise if staffing thins. Essential inspections and emergency response proceed with priority. Stay with official channels. OMB and OPM issue memos. Agencies publish contingency plans. Unions share guidance. All employees should rely on written instructions and keep a personal record of dates and hours. Bottom line: shutdowns are managed by law. Services are triaged, pay is delayed, and recovery follows funding. Plan, communicate, and document, so workers, contractors, and the public can navigate with clarity. North America's wealth starts with scale. The United States anchors regional GDP, with Canada and Mexico smaller but tightly linked through trade, finance, and supply chains. GDP level. The U.S. leads in nominal output by a wide margin. Canada's economy is mid-sized. Mexico's is rising with manufacturing and energy. Together, integration lifts all three. Net household wealth is deepest in the U.S., broad equity and housing ownership plus retirement accounts. Canada is strong but smaller in aggregate. Mexico's household net worth is growing from a lower base. Capital markets depth. U.S. exchanges and bond markets dominate listings, liquidity, and price discovery. Canada's exchanges focus on finance, energy, and materials. Mexico's market is smaller but strategic. Venture capital and startups. The U.S. captures most VC dollars and unicorns. Canada's tech hubs expand steadily. Mexico's venture scene grows with fintech and logistics. R&D spend. The U.S. leads in total dollars and frontier facilities, labs, universities, and corporate research. Canada invests strongly per capita. Mexico's R&D base is smaller but advancing in applied fields. Income lens. U.S. GDP per capita and median incomes are higher on average. Canada tracks closely in living standards. Mexico narrows gaps via export manufacturing and services. Method matters. Nominal versus PPP. Balance sheets and credit. U.S. Treasuries anchor safe assets. Deep corporate credit and mortgages add flexibility. Canada's markets are robust. Mexico's financing mix is shallower but diversifying. Governance friction exists. Continuing resolutions, debt ceiling standoffs, and shutdowns can delay federal pay and contractor invoices, even when arrears are later made whole. Mitigations matter. Cash buffers, prompt pay rules, and automated procurement portals reduce disruption, so agencies and suppliers bridge short gaps without losing capacity. Bottom line, the United States is very wealthy, with unmatched capital markets and strong R&D, while Canada and Mexico advance alongside. But governance friction can interrupt pay temporarily. Execution and transparency keep confidence intact. When Washington hits shutdowns or debt ceiling standoffs, confidence wobbles, headlines spike, cash flow timelines tighten, and markets reprice near the X date without changing the real size or strength of the U.S. economy. Ratings agencies watch closely. Outlooks shift, watch lists appear, and a downgrade risk is signaled. The message? Friction raises borrowing costs at the margin, and credibility is an asset you must protect. Yields react first. T-bills around the X-date demand a premium. The curve kinks, CDS widens, and money markets shuffle collateral. Signals of timing risk, not national insolvency. Treasury auctions tell the story in real time. Bid to cover, tails, and indirect participation show how demand shifts by tenor as investors avoid dates with perceived timing noise. Broader markets wobble. Equities fade. The dollar and gold recalibrate, and funding spreads edge wider. Payment systems still run. Pipelines and procurement continue, but with tighter cash windows. Typical resolution? Congress raises or suspends the ceiling before default. Shutdowns pause some agencies, but debt service continues. Ceiling fights are legal timing constraints, not proof of inability to pay. Distinguish liquidity management from poverty. The U.S. has vast income, assets, and tax capacity. Short-term cash timing under a legal cap is not national impoverishment. It's governance risk that adds basis points. International confidence weighs signals. Reserve managers hold treasuries, but outlook shifts and noisy brinkmanship can tax credibility. Over time, rule of law and growth restore the spread. Transparency calms. Publish the X-date range, daily cash balances, and auction calendars. Explain contingency steps and payment prioritization policies in plain language. Treasury and primary dealers huddle. Investor calls, roadshows, and dealer feedback tighten communication loops, keeping funding orderly while lawmakers finalize terms. Bottom line, resolve on time, protect credibility, and keep procurement funded. Manage liquidity with clarity, and separate political theater from economic fundamentals. Resilience starts in community halls and in how budgets get done. The fixes are practical. automatic continuing resolutions to prevent shutdowns, a modern calendar for markups, and plain language updates the public can follow. First, automatic continuing resolutions. When the deadline hits, government doesn't stop. Paychecks and services continue at prior levels while Congress keeps voting. No brinkmanship, no chaos. Modernize the process. Realistic timelines, fewer omnibus bills, and multi-year appropriations for payroll-critical functions, troops, air traffic, border, labs, so essential teams never miss a check. Reform the debt ceiling. Pair fiscal rules with automatic adjustments tied to enacted budgets, so credit isn't weaponized and payments to households and contractors stay on time. Boost cash flow transparency. Daily Treasury balances, inflow and outflow dashboards, and forward payment schedules. Clear, machine-readable, and easy to monitor locally. Agencies post the same view. When payroll runs, when vendors are paid, and what's pending, so cities and suppliers plan with confidence. Citizen actions. Contact your representatives to back automatic CRs, multi-year pay for essential staff, and debt ceiling reform. Subscribe to Treasury, OMB, and CBO alerts. Read the notes before sharing. Pair students with seniors to set up official notifications, Social Security, VA, state benefits, and scam blockers. Log each visit, confirm alerts actually arrive. Post-action boards, district office contacts, markup calendars, sample emails, and how to track appropriations, plus a simple explainer on what an automatic CR does. Run a 72-hour loop. Flag a rumor. Check official updates. Correct the record. And follow up with your reps. Track promises to votes. Then publish the results. Discipline beats drama. Every time. Celebrate good process. Town halls show dashboards. Corrections are courteous. And every claim links to sources the public can verify. The checklist. Automatic CRs. Modern budget calendars. Multi-year pay for essential roles, debt ceiling reform, and cash flow transparency. Citizens, contact reps, subscribe to official updates, then act together. Is China the new world leader? Or just larger in scale? Start with money and markets. China's share of global GDP rose fast since the 1990s, while the US remains the anchor. Home to the dominant reserve currency, the deepest bond and equity markets, and the benchmark safe asset. Scale shows up in factories and ports. Container megaships, automated cranes, and supplier parks compress time and cost. China leads in sheer throughput. Peers, EU, Japan, Korea, hold high-precision niches that feed the same networks. Is the US getting weaker? Not in innovation. Frontier labs, startups, and GPU clusters for AI keep America at the edge. Top citations, leading venture funding, and the largest cloud capacity among peers. Semiconductors decide leverage. China leads assembly and materials at scale. The US, Taiwan, the Netherlands, Japan, and Korea hold advanced lithography, EDA, and leading-edge wafer starts. Finance tilts west. The dollar dominates settlement and reserves. Treasuries set global collateral. UN invoicing grows regionally. But what matters is actual settlement flows, not headline FX turnover. Logistics shape power. China's megaports and rail links speed exports. US airlift, sea lift, and alliances project reach, keeping lanes open when crises hit. Standards and platforms matter. 3GPP, ISO, and cloud ecosystems set defaults. Leadership is who writes the rules, and who markets follow by habit. Soft power counts. Universities, films, music, games, and visas draw talent. America's cultural gravity remains deep. More contested online, but still magnetic. Compare peers, not slogans. The claim that the US is poorest in North America is inaccurate. By GDP per capita and incomes, the US far exceeds Mexico and is comparable to or above Canada on income measures. Wealth varies with distribution and methods. Signals are mixed. America's global share is smaller in a bigger world. But innovation capacity, market depth, reserve currency role, and alliance networks remain strong. Headlines that skip context mislead. What to watch? Reserve currency share and settlement flows. market depth and liquidity, patent quality, chip nodes by wafer starts, port dwell time, grid uptime. Signals, not sound bites. Leadership isn't a headline. It's execution under pressure. Scale, rules, finance, and trust aligning without gaps. Frame the contest clearly. China's rise is measurable. America's foundations, innovation, capital, alliances, and law remain powerful in practice. Shanghai, scale you can see. New York, finance and ideas in motion. Then the board, scale, rules, finance, trust. Keep score in the open and adjust with speed. Final read, China's momentum versus America's resilience. Payroll hiccups still happen in rich countries. Cash flow timing, appropriations delays, and IT outages, not lack of national wealth. Outcomes will be earned by strategy, speed, and credible execution. Over the long arc, power shifts quietly. In a multipolar era, the question isn't who dominates, it's how nations compete, cooperate, and keep risk contained. Scenario 1. Competitive co-evolution, managed rivalry, shared standards where it helps, redundant supply chains, and hard competition in chips, AI, and energy. Scenario 2. Bifurcation, split tech and finance stacks, tighter export controls, currency blocks, and slower diffusion of ideas across firewalled systems. Scenario 3. Crisis-driven realignment. A shock forces selective cooperation in health, climate, and finance, or hardens blocks if trust collapses. In this world, leadership means convening power, standard setting, resilient economies, and reliable public goods. Less spectacle, more stewardship. The U.S. today, challenges: polarization that slows consensus, rising debt service, and aging infrastructure that drags on productivity. And strengths: world-class innovation engines, deep capital markets, dense alliances, and rule-of-law institutions that attract talent and investment. Fact check: the United States is not the poorest country in North America. By GDP per capita and median income, it sits near the top. Check the data before sharing claims. Federal pay delays usually stem from budget impasses and legal process lapses. Continuing resolutions, shutdown procedures, or contracting rules, not an inability to pay. Treasury disperses when Congress authorizes and agencies certify. For the record, read OMB apportionments, Treasury reports, GAO audits, and agency notices. Keep debates evidence-based, BEA, BLS, Treasury, IMF, and World Bank. Facts over myths.